IBIT ETF explained. Should you invest in Bitcoin futures? Hey everyone, and welcome to the channel. Today, we're diving deep into the world of Bitcoin and exploring the IBIT ETF, a unique way to gain exposure to this volatile asset. Whether you're a seasoned crypto investor or just curious about this new financial instrument, this video is for you. We'll break down everything you need to know about IBIT, from how it works to its potential benefits and drawbacks. So, buckle up and get ready to learn all about the IBIT ETF. Question 1. How does the IBIT ETF select its underlying assets or holdings? The IBIT ETF, launched in January 2024, doesn't actually hold any underlying assets or traditional securities. Instead, it tracks the performance of the CME-CF Bitcoin Reference Rate New York Variant Index. This means its price directly reflects the price of Bitcoin, without directly holding any of the cryptocurrency itself. Here's a breakdown of how it works here. Index tracking. The IBIT ETF is passively managed, meaning it doesn't actively select individual companies or assets. Instead, it aims to replicate the performance of the chosen index, in this case, the CME-CF Bitcoin Reference Rate. Price discovery. The CME-CF Bitcoin Reference Rate is established based on the price of Bitcoin traded on major regulated exchanges in the US. This price discovery mechanism ensures transparency and reflects real-time market conditions. Physical exposure. While IBIT doesn't hold Bitcoin directly, it provides investors with physical exposure to the asset class. This means any price fluctuations in Bitcoin will be directly reflected in the ETF's price. Therefore, unlike traditional ETFs that hold a basket of underlying assets, IBIT relies on an index to track Bitcoin's performance, offering investors a way to gain exposure to the cryptocurrency without directly owning it. Question 2. How are sector and industry weightings determined within the IBIT index? The IBIT ETF, IBIT, does not track an index that reflects the performance of Bitcoin. Instead, it holds a basket of futures contracts on Bitcoin, specifically CME Bitcoin futures contracts. This means that while IBIT doesn't directly hold Bitcoin, it still provides exposure to the price movements of the cryptocurrency. Here's a corrected breakdown of IBIT's underlying assets. 1. Futures contracts. IBIT holds a basket of nearby and next month CME Bitcoin futures contracts, which are agreements to buy or sell Bitcoin at a predetermined price on a specific future date. This allows the ETF to track Bitcoin's price movements without directly holding the cryptocurrency. 2. Price exposure. The price of each futures contract in the basket reflects the expected future price of Bitcoin. As the price of Bitcoin fluctuates, the price of these futures contracts will also adjust, impacting the overall value of the IBIT ETF. Therefore, understanding sector and industry weightings isn't relevant for IBIT, as it doesn't hold stocks categorized by these classifications. Its primary focus is on tracking the price of Bitcoin through its holdings of Bitcoin futures contracts. Question 3. How frequently are the holdings within the IBIT ETF rebalanced or adjusted? The holdings within the IBIT ETF, which consists solely of CME Bitcoin futures contracts, are rebalanced or adjusted continuously throughout the trading day. This means that the composition of the futures contracts in the basket is constantly changing to maintain the desired exposure to Bitcoin and reflect market movements. Here's a breakdown of the rebalancing process. 1. Continuous monitoring. The ETF provider, Van Eck, continuously monitors the prices and expiries of the Bitcoin futures contracts in the IBIT basket. 2. Rolling over contracts. As contracts near their expiry date, they are replaced with new, further dated contracts. This process ensures that the ETF maintains exposure to Bitcoin and avoids potential price discrepancies due to expiring contracts. 3. Dynamic adjustments. The specific composition of contracts within the basket, such as the ratio between nearby and next month contracts, might be adjusted based on market conditions and the ETF's investment objectives. This helps IBIT track Bitcoin's price more closely and efficiently. It's important to note that this continuous rebalancing doesn't involve buying or selling actual Bitcoin. Instead, it involves adjustments within the basket of futures contracts, ensuring the ETF reflects the latest market dynamics and maintains its desired exposure to Bitcoin. Question 4. How does the IBIT ETF mitigate risk or volatility within its investment strategy? While the IBIT ETF offers exposure to Bitcoin, it's important to understand that it doesn't inherently mitigate risk or volatility within its investment strategy. In fact, it's inherently exposed to the same fluctuations in price and volatility as the underlying Bitcoin asset itself. Here's why. Exposure to Bitcoin price volatility. Bitcoin is known for its high price volatility, meaning its value can swing significantly in both directions. This inherent volatility is directly reflected in the price of the IBIT ETF. Investors should be aware of this risk before investing in IBIT, as it doesn't offer any built-in mechanisms to reduce volatility. Futures contract risks. While IBIT avoids directly holding Bitcoin, its reliance on futures contracts introduces additional risks. 1. Roll costs. The continuous rolling of expiring futures contracts can generate transaction costs, which eat into the ETF's returns. These costs can be amplified during periods of high volatility. 2. Basis risk. The price of Bitcoin futures contracts may not perfectly align with the spot price of Bitcoin, leading to potential tracking errors for the ETF. This mismatch, known as basis risk, can further increase the volatility of the IBIT ETF compared to the underlying asset. 3. Margin requirements. IBIT uses margin to hold its futures contracts, which can amplify market movements in both directions. This means that a 10% price swing in Bitcoin could translate to a larger swing, positive or negative, in the price of the IBIT ETF. Alternatives for mitigating volatility. If you're seeking to mitigate volatility in your investments, here are some alternatives to consider. 1. Diversification. Diversifying your portfolio across different asset classes, including less volatile ones like bonds or low volatility stocks, can help spread risk and reduce overall portfolio volatility. 2. Fixed income ETFs. These ETFs invest in government or corporate bonds, offering lower volatility and regular income compared to Bitcoin and the IBIT ETF. 3. Low volatility equity ETFs. These ETFs focus on companies with historically lower stock price volatility, aiming to provide smoother returns compared to the broader market. Question 5. How has the IBIT ETF performed in different market conditions? including upturns, downturns, and periods of volatility. The IBIT ETF, launched in January 2024, is still relatively young, making it challenging to analyze its performance across various market conditions with extensive historical data. However, we can examine its initial performance and consider how it might behave based on its underlying structure. Upticks year. IBIT's price should theoretically rise alongside Bitcoin's price during market uptrends. This is because the ETF's holdings track Bitcoin futures contracts, which aim to capture the asset's price movements. However, the continuous rolling of futures contracts might introduce some roll costs, reducing returns compared to direct Bitcoin ownership, especially during strong uptrends. Downturns. IBIT's price is likely to fall when the Bitcoin market experiences downturns. As with upticks, the magnitude of the decline might be amplified due to roll costs and margin requirements, where a decrease in Bitcoin's price could lead to larger losses in the ETF. Periods of volatility. IBIT's exposure to Bitcoin futures amplifies its volatility compared to directly holding Bitcoin. This is due to factors like basis risk. When the price of futures contracts deviates from the spot price of Bitcoin, the ETF's price might not perfectly track the underlying asset, leading to additional volatility. Margin requirements. As mentioned earlier, margin requirements can magnify market movements, potentially causing larger swings in the ETF's price during volatile periods. Question 6. How are performance metrics calculated, and what are the key drivers of returns for the IBIT ETF? The performance metrics for the IBIT ETF are calculated in a similar way to other ETFs, but with some nuances due to its unique structure. Here's a breakdown. Calculating performance. 1. Total return. This metric considers both the change in the ETF's share price and any dividends or distributions paid out. Since IBIT doesn't distribute dividends, its total return primarily reflects price changes. 2. Net asset value, NAV. This represents the value of all the assets held by the ETF per share. For IBIT, it reflects the net value of its Bitcoin futures contracts. The change in NAV over time contributes to the total return. 3. Expense ratio. This is the annual fee charged by the ETF provider, VanEck, to cover operating expenses. It's deducted from the NAV and reduces the overall return for investors. Key drivers of returns. 1. Bitcoin price movements. The primary driver of IBIT's returns is the price of Bitcoin itself. As the price of Bitcoin goes up or down, the value of the ETF's futures contracts and its NAV will follow accordingly. 2. Roll costs. As mentioned earlier, the continuous rolling of expiring futures contracts can generate transaction costs. These costs eat into the ETF's returns, especially during periods of high volatility or significant price movements. 3. Basis risk. The difference between the price of Bitcoin futures contracts and the spot price of Bitcoin can impact the ETF's performance. If the basis is negative, futures contracts are cheaper than spot, it can lead to tracking errors and lower returns for IBIT. 4. Margin requirements. The use of margin to hold futures contracts can amplify both gains and losses. This means that market movements can have a larger impact on the ETF's price compared to directly holding Bitcoin. Additional considerations. 1. Tracking error. This metric measures the difference between the IBIT ETF's returns and the returns of its underlying index, in this case, the performance of Bitcoin. While IBIT doesn't directly track an index, its performance is still closely linked to Bitcoin's price movements. Any deviations due to factors like roll costs or basis risk contribute to the tracking error. 2. Taxes. Depending on your location and investment strategy, the way IBIT is structured can have tax implications. Consult with a tax advisor for specific guidance. By understanding these metrics and drivers of return, you can gain a deeper understanding of how the IBIT ETF performs and make informed investment decisions based on your risk tolerance and investment goals.